January 31st, one single trading day, 27 tons of silver, gone. Not slowly drained over weeks, not quietly absorbed through routine industrial orders, vanished. In a single session on the Shanghai Gold Exchange, more physical silver disappeared than most nations pull out of the ground in an entire month. And the mainstream financial media, they reported nothing, not a word, not a single headline. But here is what they are not telling you. The buyers who emptied those shelves were not day traders chasing a quick profit. They were not retail investors panic buying coins at their local dealer. The entities that swept 27 tons of physical silver off the market in one day were industrial conglomerates, state-backed procurement agencies, the end. The quiet hands of a government strategy that has been building for years. A strategy that is now accelerating so fast that the window for ordinary people to act is closing by the hour. This is not a price story. This is a supply story. And once you understand the difference, you will never look at silver the same way again. Let us start with what actually happened on January 31st, because the raw number, 27 tons, does not fully communicate the violence of what occurred. To put it in perspective, the average daily withdrawal from the Shanghai Gold Exchange's silver vaults over the previous 12 months was approximately 2 to 3 tons. On January 31st, that number did not double, it did not triple. It multiplied by nearly 10 times in a single day. In the world of commodity markets, that kind of movement is not a trend, it is a detonation. When you see a number like that, the first question any serious analyst asks is not where the price is going. The first question is why. Why did someone, or a group of someones, need 27 tons of physical silver so urgently that they were willing to clear an entire exchange's daily inventory in one trading session? Because buying at that scale and at that speed is not efficient. It drives up your own cost. It signals your position to every competitor in the market. No rational actor does this unless the alternative, not having the silver, is far more terrifying than the premium they pay to get it immediately. The answer lies in a shift that has been quietly unfolding for the past 18 months across manufacturing centers in China, South Korea, and Southeast Asia. The phrase "just in time," the supply chain philosophy that dominated global industry for 4 decades, is officially dead. What replaced it is a concept that is now driving the most aggressive physical commodity hoarding the world has seen since World War II. The new philosophy is called just in case, and silver is at the center of it. Here is the industrial reality that most financial commentators are too removed from the factory floor to understand. Silver is not simply a precious metal. It is the most electrically conductive element on Earth. There is no substitute for it in the applications that are now growing fastest: solar panels, solid-state batteries, electric vehicle charging systems, advanced semiconductor contacts, and next-generation defense electronics. When a solar panel manufacturer in Guangzhou or a battery gigafactory in Shenzhen runs out of silver, their production line does not slow down. It stops completely. A $50,000 electric vehicle cannot be finished without the silver worth approximately $40 inside it. The math is brutal, and the incentive is absolute. You pay whatever it costs to have the inventory, because the alternative is that your $40 million factory sits idle. This is the definition of inelastic demand. And inelastic demand, colliding with a supply chain that was already stretched to its limits, is exactly what creates the kind of event we saw on January 31st. See, when procurement managers in these facilities saw the inventory data coming out of the Shanghai vaults in early January, when they watched the numbers declining week after week, they did not hold a meeting to discuss price sensitivity. They panicked. They picked up the phone and told their brokers to buy everything available. The 27 tons that left the Shanghai Gold Exchange in one day did not go to a speculator's vault. That silver went into production pipelines. It went into products that are being assembled right now. It is already gone. Now let us talk about what is happening on the other side of the world, because the Shanghai event is not happening in isolation. It is the Eastern expression of a crisis that is squeezing the global silver supply from both ends simultaneously. While China is vacuuming up physical inventory with industrial urgency, the Western supply pipeline is fracturing under a completely different kind of pressure. We have confirmed reports from major precious metals dealers across Germany, the United States, and the United Kingdom that delivery times for standard silver coins, the 1-ounce Philharmonic, the American Silver Eagle, the Canadian Maple Leaf, have exploded to between 6 and 8 weeks. Let that sink in. You are placing an order today for silver that you hope to receive in February, and the word hope is not rhetorical. Several dealers have quietly told their wholesale clients that they are selling inventory they do not yet physically possess, betting that the mints will be able to fulfill the orders before the delivery window expires. This is not a logistics problem. This is not a shipping delay. What we are watching is a retail-level physical default. The buffer that normally sits between the wholesale market and the individual buyer, the dealer's floor inventory, the distributor's warehouse stock, has been completely drained. The pipeline is empty. And when a pipeline empties this fast, there is only one mechanism that can restore equilibrium: price. But here is the part of this story that most analysts are missing, and it is the most important part. The price you see on your phone right now, the spot price quoted on financial apps and television tickers, is not the price of silver. Not anymore. What you are seeing is the price of a paper contract. It is the price of a promise. The price of actual physical silver. The kind you can hold in your hand is already trading at a premium of $9 to $12 per ounce above that spot price. If you walk into a dealer today and try to buy a single ounce, you are not paying the quoted market price. You are paying the real price, and the real price has already broken through $90. This divergence between the paper market and the physical market is not a technical anomaly. It is a signal. It is the market telling you that the institutions that have historically set the silver price, the major banks that run the futures contracts on the commodity exchange in New York, are losing their grip on the narrative. They can suppress the paper price by issuing more contracts. They cannot issue more physical metal. And when the physical metal is gone, the paper price becomes a fiction. We are watching that fiction begin to crack. The Shanghai data makes this undeniable. When the closing price on the Shanghai Gold Exchange for silver is running $8 above the New York Commodity Exchange price, you do not need a finance degree to understand what happens next. Every major trading desk in the world sees that spread. Every algorithmic system sees that spread. And every rational actor with access to physical metal in London or New York sees a risk-free arbitrage opportunity. Buy in the West, ship to Shanghai, sell for $8 more per ounce. After transport and insurance, you still clear $5 to $6 per ounce in pure profit. Multiply that by the millions of ounces moving through these pipelines, and you understand why the Western vaults are hemorrhaging inventory. This is not speculation. We are watching it happen in the official data. The registered silver inventories at the Commodity Exchange in New York, the physical metal that is actually available for delivery against futures contracts, has been falling for months and is now sitting at levels not seen in over a decade. Meanwhile, the open interest on those same futures contracts, meaning the total number of paper promises to deliver silver, remains enormous. The ratio of paper contracts to available physical metal has reached a point that would have been considered absurd by any standards of sound market operation even 5 years ago. What does this mean in plain language? It means the system is running on faith. The faith that buyers of paper silver contracts will not, en masse, demand physical delivery. The faith that the spread between Shanghai and New York will somehow not attract the arbitrage it mathematically demands. The faith that industrial demand will somehow slow down just in time to allow the mines to catch up. None of these faiths are well-founded, and January 31st was the moment when the mathematics began asserting itself over the faith. Let us talk about the mining side of this equation, because it is where the supply crisis becomes truly structural. The world produces approximately 800 to 900 million ounces of silver per year from mines. That sounds like a large number until you compare it against the demand picture that is emerging from the green energy transition alone. The International Energy Agency has projected that by 2030, the solar power industry alone will require more silver annually than the entire world currently mines. Not a portion of it, all of it. And that is before you account for the explosive growth in electric vehicle production, defense spending, consumer electronics, and the industrial hoarding that events like January 31st represent. New silver mines cannot be opened quickly. The permitting process in most countries takes 3 to 5 years at minimum. The actual construction and development of a mine from approved permit to first production takes another 5 to 7 years. The pipeline of new silver supply is essentially fixed for the next decade. What the market is working with right now is largely what it has been working with for years. And that supply, which was already struggling to meet demand in normal conditions, is now being subjected to a demand shock of historic proportions, driven simultaneously by the Shanghai industrial machine, the global energy transition, and a growing wave of retail investors who are beginning to understand what institutional buyers already know. There is one more dimension of this story that the financial press is almost entirely ignoring, and it may be the most consequential of all. Resource nationalism is no longer a theoretical risk. It is an active policy being implemented by the governments of the world's largest silver-producing nations. Mexico, which produces more silver than any other country on Earth, has been moving steadily toward tightening state control over its mining sector. Peru, the second largest producer, is facing ongoing political pressures that have disrupted mine operations multiple times in the past 2 years. Bolivia has already moved to nationalize significant portions of its mining industry. What happens to the global silver price when the governments of these nations decide, as they very likely will, that their strategic industrial interests require them to retain their silver rather than export it at prices denominated in a currency that is visibly losing its purchasing power. The answer is not a price increase. The answer is that there is no price because there is no silver available for purchase in the open market. This is the scenario that the entities buying 27 tons in a single day are hedging against. They are not buying because they think silver is cheap. They are buying because they are terrified of a world in which silver is simply unavailable. And once you understand that motivation, the premium they paid, the urgency with which they acted, stops looking like irrational panic and starts looking like the most rational risk management decision imaginable. The window for ordinary investors to act alongside these institutional buyers is not infinite. The arbitrage between paper and physical markets cannot persist indefinitely. Either the paper price rises to meet the physical reality, which is what the mathematics demands, or the system that produces that paper price breaks down entirely. The first scenario produces a silver price that the majority of analysts today would consider extraordinary. The second scenario produces something far more disruptive to the existing financial order. You are watching a market transition in real time. The transition from a world where price discovery happens on a screen in New York based on paper contracts to a world where price discovery happens at the point of physical exchange, in Shanghai, in Frankfurt, in the hands of the dealer who tells you what it will cost to actually hold metal in your hand. That transition is not coming. It is here. January 31st was not an anomaly. It was a preview. The question you have to ask yourself is simple. When the next 27-ton day arrives, and based on the structural forces driving this market it will, do you want to be on the side of the people who prepared or on the side of the people who watched? We have walked through every layer of what happened on January 31st. The industrial panic, the draining vaults, the fracturing paper market, the resource nationalism closing the supply door, the mathematics that no amount of futures contracts can override. This is not a moment for hesitation. The entities that moved 27 tons in a single day were not confused about what they were doing. They were executing a strategy built on a clear-eyed reading of physical reality. You now have access to the same information they used to make that decision. If this analysis showed you something the mainstream press refused to cover, then hit subscribe and activate the notification bell right now. Every week we go deeper into the forces reshaping the financial world, the data they bury, the trends they ignore, and the strategies that actually protect real wealth. Share this video with one person who needs to hear it. The algorithm rewards engagement. And more importantly, the people in your life deserve to have this information before the window closes. We will see you in the next one.